You are predominantly at Oaktree a credit market investor.
Right.
I know you've spoken about this many times, but I still want to ask you this because I want to hear it from you. Why did you choose credit markets over equity?
Well,
because I think only about 4% of your assets.
You know, after about 10 years, there came to be a good stopping point for my work in equities. Basically, I had progressed about as far as I would go. I became director of research at Citibank at the tender age of 29, and the other reason is that the bank's equity activities really did not fare well. The bank was a nifty 50 investor at a time when those stocks were penalized, and a new CIO came in who wanted his own director of research, and I had to find a new position, and I was offered one in the bond department, and I took that to start a convertible bond portfolio and then a high yield bond portfolio. So it wasn't some master stroke.
Okay.
I just seized an opportunity that was presented to me.
And you stayed with it for decades.
Well, until now. Right.
But yeah, I think I was checking the numbers, and you have about only 4% of your assets under management in equities, and most of that in emerging market equities.
Right.
Correct. So equities really is not an important part of your investment portfolio at all.
No, that's right. Well, first of all, you can't be good at everything.
Yes.
And we have carved out a niche and an expertise for ourselves in credit. And I think one of the big mistakes people make is that they do something well and they say, well, then I must be a genius. I must be able to do everything well. And we don't deceive ourselves in that way. We're active, as you say, in a few special niches. We have funds in emerging market equities, Japanese equities, and U.S. tiny caps.
Right.
And that's it. You know, we may branch out, but that's it for now.
Off that, one of the things you said this morning struck me, and I'm only still talking about equities. You said that we don't invest in technology, it doesn't fit our risk control strategy.
Right.
Technology is the biggest revolution in our lifetimes, at least. And you're not putting any money on it?
Well, again,
why?
And by the way, my comment about technology is not with regard to just equities, but any place. We don't invest much in technology, bonds, loans, anything. And technological is revolutionary, but challenging. When there's a revolution, you have to be on the right side. It's not so easy to be on the right side. In technology, there are pronounced winners and losers. Our approach is to emphasize sectors where the outcome is more predictable. You know, back in '99, we had something called the tech bubble. And people said, the internet is going to change the world, and so you should invest in internet companies, and there's no price too high. And if you invested in internet companies, you lost money in 99% of them, and in most of them, you lost 99% of your money.
Yeah.
So, change the world is not synonymous with successful investing. We stick away from technology. It is not our expertise, and it is not something that we feel we can predict with consistency.